Do you like giving the government money? Neither do I. But unfortunately, high net worth investors typically have to end up walking the tightrope between tax risk and investment risk. Watch on for a story today of a client who had a liquidity event where we looked down every nook and cranny to optimally reduce their tax burden. And definitely watch to the end for a few items that you probably haven't seen other places. Hey everyone, I'm Andrew. I'm a CFA charterholder and a CFP professional who spent the last several years working with ultra high net worth and high net worth investors. I'm also the owner of Lever Wealth Management, which is the advisor for people who scare financial advisors. And what I do is I take these learnings from the thousands of iterations over time and I give them to you so that you can apply them to your own situation. I had a client recently who had a liquidity event. They had private company stock and the company was being bought out through a M&A opportunity. So we went through a few different items. They were going to end up with a couple $1 million in their IRA and a couple $1 million in their taxable account, depending on the final purchase price. The first thing I asked this person is, has a letter of intent been signed? And the answer was no. And the next question is, do you know if there's any binding agreement to sell the company within a period of time at a certain valuation? And the answer was no. Because what I've seen with many people is whenever any murmurings of a liquidity event happen, if there's a signature that says, we're going to consider buying your company for X amount, and you do any conversions from an IRA to a Roth, or if you give any of your equity to a charitable organization or anything like that, the IRS is going to look back at that and they're going to say, you knew your company was selling. No. You have to pay the taxes on that. And so with this person, the answer was no. None of those had been breached. So the first thing they did was they converted all of their IRA shares to a Roth IRA. Well, now that was about 700,000, give or take, that will now be in a Roth IRA for $2 million. Okay, think of the tax savings on that. Yes, you're paying tax up front on the 700,000 conversion, but tomorrow you wake up and you have $2 million of tax-free money. Significant tax savings. That was the lowest hanging fruit of anything. And so if you want to turn off the video now, just understanding that transferring IRA dollars to a Roth IRA before a letter of intent is signed, that's probably a good takeaway for the video. But we didn't stop there. Instead, what we did is we said, okay, now we have 700,000 of earned income plus your current earned income for the year. And now we have about a $2 million capital gain tax that we have to worry about. And so the first order of operation is, what do we need to do to take care of that earned income? And there were a few different buckets that these items fell into. I'm going to call them the normal bucket, the tax credit bucket, and the really aggressive bucket, okay? And in the normal bucket, you start looking at things like private real estate and oil and gas investments. Why? Because there are oil and gas exploration and drilling credits, where if you put $100,000 into one of these investments, you can get an 80 to 85% deduction off the top line of your taxes. That's very significant. Now, oil and gas is private as an investment opportunity, and there's significant risk where you have risk to the operator, right, performing up to standards, and you have macro risk of oil prices in general. It's a commodity where you don't actually effectuate the outcome that you get, okay? So there's risk with it. On the real estate side, you can do things like purchase a short-term rental unit or even long-term rental units, and then depending on the type you purchase, you can do what's called a cost segregation analysis, where you get to bring forward depreciation of certain items, such as the plumbing, the electrical, things like that, where you end up with a first-year deduction in the 10 to 15% range at the purchase price, right? So you buy something for $500,000, maybe you get to write off 50 to 75,000. Not nothing. However, you use up a lot of liquidity to make those purchases. So pros and cons. The next bucket that we looked into was, okay, can we just go out and buy some tax credits? There are many large companies that purchase and sell tax credits from each other. It's actually a somewhat liquid market, and there are some large public accounting groups that will actually broker these deals where you can buy a tax credit for anywhere from 85 to 92 cents on the dollar. The problem as we went down this road was a $4 to $5 million liquidity event is simply not high enough to effectuate the transfer of these credits. On the state side, you want the liability to be anywhere in the 150 to 200,000 range. And on the federal side, the liability would need to be in at least the $3 to $5 million range for you to be somebody that would be able to buy those tax credits. Furthermore, with those, sometimes they are subject to ongoing projects, right? They're tax credits for renewable energy that these companies got and don't need anymore, so they sell them to a different buyer. Well, the problem is what happens with your tax credit if the project doesn't go through? And you can buy some insurance protection on that, but insurance companies have a nice way of trying not to pay out whenever a claim actually occurs. And so the more we got into that, there were some fill and tax credits actually in their state that could have made sense, but they were about 95 cents on the dollar. And it just didn't seem like enough of a tax savings to give the result that we wanted. And so that led us down the aggressive route where you start looking at some Section 179 deductions. There were even some box homes that were being created that fell under the Section 179 deduction, where you can expense an item in 1 year rather than depreciating it over its whole life. In addition to that, there were some solar farm opportunities that we could look at, and even some historical preservation tax credits. And what we found, especially with the Section 179, even some equipment leasing, things like that, is there's significant tax risk with those. And you need a really good CPA or tax attorney in your corner to understand your tax position and then defend it at the end of the day. Almost all of these had purchased audit protection, which is probably an alarm flag. And that doesn't mean that some of those are not legitimate. What it means is there's risk involved, and you need to quantify the risk and understand it and take your position of your risk tolerance for not only investment risk, but tax risk. And so where we ended on the active income is we decided to put a fair amount into oil and gas investments with different operators to be able to take advantage of some of those intangible drilling credit. They didn't have any big philanthropic goals at this time, but there was a private equity opportunity that invested in some historical preservation where they not only owned the real estate, but got some tax credits at a multiplier. So you put $1 in, you end up getting anywhere from $1.50 to $2 of a tax deduction. It's very specific and there's some risk in it. However, this client felt it still met their goal, and they believed in the idea of preserving these historical buildings and changing the function of them. And so between doing the oil and gas, doing some of the private equity, we ended up eliminating a fair amount of the federal income tax liability. We then move on to the capital gain side and go, okay, there's a $2 million capital gain. What are we going to do to eliminate this? And unfortunately, the options are far more limited on that. Charitable deductions do go against AGI, anywhere from 30 to 50%. So that would cut the capital gain down, and it did some, but it wasn't something that we wanted to spend a lot of the liquidity on. What you can do, though, is do some qualified opportunity zone investments where you identify properties and then you get to defer the capital gain until 2026, April of 2026. There are also some thoughts that under the new administration with Trump that this may be extended. And so we decided to do some qualified opportunity zones investing because they are a real estate investor. That deferred the tax on about $1 million of that $2 million capital gain. And so when you add everything up, from the Roth conversion to reducing the active income through the oil and gas investments, through the qualified opportunity zone investing, through the private equity investment, when you add all of these up, it was somewhere in the neighborhood, depending on how you calculate it, of $400,000 in tax. Other people may watch this video and go, why in the world did you guys go down all of those rabbit holes? Just pay the tax, put some in a donor advised fund or in a charitable remainder trust, and call it a day. That's absolutely fine. My point with this video is to show in high net worth investing, in wealth management, you optimize for different things given the guardrails you put in your own retirement. And for this person, we really wanted to optimize their tax efficiency with the year that they were selling their business, subject to the constraints that they did not want to take tax risk that was unnecessary. And so we ended up doing some very normal things: oil and gas investments, qualified opportunity zone investing, and some private equity investments. In between those three, we were able to pull enough levers to have significant tax savings, not to mention the Roth conversions on the front end. So I hope this example gives you a few things to think about with your own situation. And until next time, thanks everyone.